You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so last week we had a chance to get together and do a little huddle up and answer some listener questions. So this week we're going to jump right into a new trade. We're getting to the end of earnings season, but there's a little stock out there called Uber that's going to be announcing earnings on the 8th. So meaning to say this is going to be a fairly big event, considering that Uber just came public recently. Stock's been actually kind of flat relative. If you look at the chart, kind of surprisingly, the stock hasn't moved a ton. It opened up around 42, hit a low of 36, high of 47, and as of today, the stock is trading at 39.70. It was up 55 cents on the day. But if you look at earnings, even though the stock hasn't been that volatile, the implied volatility is at 156%, and the at-the-money straddle is trading for, at the midpoint, $4.35. With the stock trading very close to 40, the math is pretty simple here. They're expecting about a 10% move on the after earnings based off of the long straddle. So, stock hasn't been very volatile. Earnings say they're going to be volatile. Should be an interesting day to be trading Uber. So, on Options Playbook Radio, as always, nothing is meant to be a recommendation, but we're going to look at a trade in Uber. And I'm going to bring a strategy that I actually don't really have a name for, that I haven't really tested around earnings, so why not do it with a stock that has just came to market this year? And so with Uber Technologies, what we're going to do is we're going to sell a call spread to pay for an out-of-the-money put. So we're looking at about a $4.35 move. That would be, if it made that move, that'd be what the marketplace expected. I always like to say that it's a lot like the over-under. We're just trying to learn here on Options Playbook Radio, so I think this is a good time to introduce a new strategy. So I'm going to go at least the expected move out of the money. I'm going to go at least 10% out of the money on this underlying. And we're going to actually use a different expiration. We're going to go a little bit further out. The closest expiration is the August 9th expiration. Uber's supposed to announce earnings on the 8th. So we're going to go out to the August 16th expiration, and that's what we're going to look at. So with Uber announcing after the market on the 8th, the 9th would only have 1 day to live. And in this strategy, what we're going to try to do is we're going to sell a bear call spread or a call credit spread to help pay for a lottery ticket out of the money on the downside. So we will have some risk. I don't like the concept of just buying an at-the-money option contract and just hoping that I get the direction right. Nobody has any idea what's going to happen after earnings, or at least they shouldn't. Nobody should have any idea besides the insiders. And in this instance, we're going to sell a call credit spread and use those proceeds to help pay for an out-of-the-money put spread. So let's start with the call credit spread. In this instance, the call credit spread right now, if we go approximately the expected move out of the money, that means with the stock trading at $39.70, we're going to sell the 44 strike call and buy the 46 strike call as protection. Right now we can get that entire trade done at the midpoint for about a 35-cent net credit. Now, I should emphasize, and I should have stated this before we got into the quotes, but we are taping Options Playbook Radio on Wednesday, the 7th of August. The markets are closed at this point in time, so they could be a little bit artificially wide, but the midpoint is around 35 cents, and they're very liquid options, a lot of volume going into this earnings. So I would hope that you could feel somewhere close to that midpoint. Now, that means that we have a 2-point wide spread. That's the maximum this spread could trade for, and that would be our maximum that we would have to pay to close it. So that's $2. Minus that net credit received, if we could fill at the midpoint, would mean our total risk is $1.65. So quite simply, what did I do? I sold this for, I'm hoping that we could execute this for a net credit of 35 cents at the midpoint. I went and looked for an out-of-the-money put option that was trading for, guess how much? 35 cents. So in that same expiration, if I go out to the 32 strike put, now the stock is at $39.70. 32 strike is about 8 points out of the money. That's not unfathomable for a move on Uber on a stock like this, considering the marketplace is looking for a 10% move anyways. So in this instance, if we get the direction right, well, it's possible that it could make double the expected move, which is about an 8-point move to the downside, and that's our whole goal. So if I look at this trade, I'm trying to find a way to get long a put. That's my ultimate goal, and I really don't want to pay for it. So that option contract, the 32 strike put with the market closed, has a good bit of open interest, and the volume today was a little bit on the light side, but the open interest is there. The volume was about 30 contracts. I'm seeing it trading at 25 cents by 40 cents, have 9 days remaining to expiration. So I could enter this all as one trade. I could say I want to go in and sell the 44 strike call, buy the 46 strike call as a protection, and at the same time buy the 32 strike put. And I want to do the entire trade at the midpoint for even. I could possibly do that if I wanted to. But most people would probably leg into it. They'd probably sell the credit spread first and see what they received and then try to pay that for the put by just putting a limit order in. Now, if I do this trade, all right, my risk is to the upside, but it would have to move more than the expected move, which is a big number, 10%. And then if it moved a little less than that, well, then I'm okay all the way across the board. If it finishes, as long as it finishes between 44 and 32, right, if it finishes in that range, well, basically I'm going to be out commissions here because I'm hoping to get this entire trade done for even or basically zero cost to me. But I do have, if we have the black swan event to the downside, I got the potential to make some capital on this because I'm net long one put at the 32 strike. Now, you could change this up. You could do a put spread. In other words, you could go a little bit higher on the strike and see if you can find maybe a 2-point wide put spread. But in this instance, with Uber being a new stock, I would rather just have the catastrophic event. So I'm just going to do something where there's a low probability that I'm going to get hit on the trade or I'm going to lose capital on the trade, but there's also low probability that I'm going to knock it out of the park. So I'm probably going to fall somewhere in between if I go and do this type of trade. And just to compare apples to apples, if I were to just come in and say, oh, I want to get short Uber, and so I'm going to buy an at-the-money put option, that 9-day option contract with the stocks trading at $39.70, the $39.50 strike, just 20 cents out of the money, is trading for $2.30 on the ask and $2.25 on the bid. So let's call the midpoint $2.25. So you're talking about $225 would be your risk on that trade if you just bought an at-the-money option contract. We're looking at something where our total risk on the trade is going to be $1.65, and that risk only happens if this moves all the way up to the 46 strike, our protection on our call option, and that happens within the 9 days to expiration, and it shoots all the way up to 46. So then we'd have the max loss on that credit spread, but we did bring in a 35-cent net credit, but then again we went and we paid for the put with it. So in that instance, our max loss would be $2 total, as opposed to $2.25 if we bought the at-the-money put. And we just got a lot of different scenarios where we come out okay by doing this trade. Now, with this all said, inside the options playbook, I can't reference a page. I can't say, oh, go to this page and learn about it. We're just combining two strategies inside the options playbook. We're looking at a short call spread and just a straight-out long put. All right, so that was a lot to take in. So let's do a summary of the trade and everything that we're talking about today. Once again, nothing's meant to be a recommendation, but this should be an interesting trade to follow on paper. We have Uber Technologies last trading at $39.70. It was up 55 cents on the day. That quote is as of Wednesday the 7th. The market is closed. We're going to look at selling a short call spread in the August 16th expiration to help pay for a long put. So the short call spread that we're selling is the 44 strike call, and then buying the 46 strike call as protection. That would be a net credit of 35 cents to the account if we executed that at the midpoint. And then we take that net credit and we're going to look to buy a put option way out of the money. And in this instance, a 35-cent put option. We're probably looking at the 32 strike put. It would be that same expiration. Net on this entire trade, we'd be getting it done for about even. We really have no debit to the account, but there would be a margin requirement of $2, which is the width of the call credit spread. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.